So let's look into this scenario. This client owes nothing today. He sold a rental condo about 14 months ago. He has never owned the primary residence since then, so he's always leased in his name. So he comes up, tells tells the realtor that he's a first-time home buyer, that he's never owned a home before. So he's lying. He's telling us incorrect information, and we found out the property address when we pulled a credit report. So now, a person coming in as a obvious first-time home buyer is now changing into this scenario. So when the objection comes that the person says, I've never owned a home, I'm obviously a first-time home buyer, as soon as we find the address information on the credit report, we have to let them know. We have to collect the proper 1003 showing the 24-month of primary residence history. So the first-time home buyer rate reduction and LLP reduction both disappear. This is not an eligible file anymore. So last week we talked about the 3-year test rule. Although 1003 is asking for the first 24 months, we want to expand it to the first 3 years, 36 months. So this 3-year test covers any residential ownership interest. Living there is irrelevant. A sold rental property 14 months ago fails it. So he is a first-time buyer again in about 22 months. So the boundary is to learn how to quote the waiver pricing before you verify the information and then retract it. It's okay to say sorry after you find out. That's how the trust and file side, right? Pivot this power to seller credit or points so that we can have proper alignment and assignment. So instead of focusing on where you lived and how did you live, we focus into did you own it? Okay, the 3-year rules apply. And let's dive into this one. An engineer couple, first-time home buyer, qualifying income was $135,000 over the $114,000 AMI limit. So no waiver was given. Credit score was at 745. Sales price is $600,000 with 5% down. Loan amount at $570,000 at 7% rate. That was what we had. And they say, so there's literally nothing for us. Why do we apply with you, Giving Tree? And why do I pursue? We'll wait for the rates to come down. So when there's no waiver available, what is our play? Becky Shi, in a case like this, what would you say to the borrower that you have nothing else to give?
Maybe I can just give them a lender credit.
Okay. How about you, Sarah C?
What was the question again? Sorry, I had a call coming in.
Oh, no worries. The question was, this borrower makes too much money, so first-time homebuyer rate reduction and fee reductions don't apply. In this case, what would you do?
The borrower has too much money?
Borrower makes too much money.
Probably increase the purchase price.
So the scenario was he's trying to put an offer in a $600,000 home with 5% down, and the quoted rate was at 7%. So as you were plugging in what feasible options we can provide, we found out
higher down pay.
But borrower doesn't have a higher down payment.
Oh.
So with a given situation, when we find out that there is no feasible first-time home buyer product to plug in to provide, and we quoted at 7%, and buyer saying they will wait and we're going to walk away, we're not going to submit an offer today, what would you do? I'm picking on you specifically because you are, a loan officer doing real estate as well.
The borrower is walking away because of the high interest, or
Yes.
is it we can work on the pay down rate, or I always usually tell the client we can always refinance.
Okay. Do you plug in any refinance promotion when you talk about refinance opportunities?
I never said anything promising.
Okay.
So that way the borrower doesn't come back and say, hey, Sarah, you said this and that, because we can't really predict like what's going to happen in a month or two. I usually tell all my clients that within 6 months of purchase your home, or at least a year, you're pretty much paying interest rate to the bank or any lender they choose to go with. So 7%, if that bothers the borrower, if you make bigger down payment and the borrower is really, really stubborn about making smaller down payment, then and the borrower assuming that the borrower really like the house and they really want the house, I would say higher down payment is ideal for the seller to accept instead of 5% down, is it doesn't look very stable in the seller's eyes. So if they want to lower the rate, I recommend a higher down payment given the fact that they do have money.
Mhm.
Yeah. I don't know if I answer it correctly, but
Oh, no, there's no specific answer. So I'm going to share
Oh.
my recommendation in a case like this.
Oh.
I wouldn't recommend to argue with the market. I
Uh-huh.
would for anyone who is paying, specifically targeted with a rate, then I would ask the buyer agent to find the subject property that is giving more credit to the buyer agent. So we restructure it with either the buyer agent commission or find out a subject property that has a seller concession on it. So target the sterile listings and negotiate the seller paid buy down or permanent buy down points, like you have mentioned.
Mhm.
So instead of saying but, I want to continue the flow momentum with the borrower saying and. I agree with you, and these are the things that we can offer, instead of arguing and like objection, providing objections to the borrower. So when the waiver is off the table, I don't want you guys to argue with the market or the situation. We pivot directly to find the subject property that the seller can pay for all these benefits.
I never want to promise about lender credit or sound like I'm promising, because again, down the road in escrow, we don't know what's going to happen. There's always changes and always unexpected situations. So usually I talk about the lender credit, if any, or buyer agents commission credit towards probably like 80% of the escrow is completed. That's when I would discuss.
Mm. Okay. We
Yeah.
have multiple promotions that's stacking up every month. So maybe adding that on top of what you are sharing to the borrowers doesn't have to hurt your credit or commission, and
Mhm.
extend, I guess, offers. Okay, let's move on to this one. This is very unique situation. This is a repeat investor who's buying investment properties using DSCR products. $500,000 rental condo, 25% down, 75% LTV. He somehow watched my YouTube video talking about lender credit and first-time homebuyer benefits, and he texted me asking me to provide a first-time buyer waiver on the rental purchase. So my response to this was to give a specific timestamp and then ask this person to watch over again. My promotion was specifically targeting on primary residence purchases only. So when you create a content, it is important to always refer a long form content leading to short form so they can always communicate the same language. So it's my fault that I didn't add these features on the long form videos that I was posting. So about starting 2 weeks ago or so, Harrison and I started to tag the short form and the long form. So whenever you are creating a content and posting on Threads or YouTube or Facebook, you make sure you have to specify the fine print what this promotion is going to benefit whom. And this is about the refi conversion. So surprisingly, major portions of the income for the last couple of months was coming from refinance, not from purchase. It's because all the market data we had on March, April, May is now deteriorating. Any sales price that we opened on month of July is significantly lower than what we had on the spring market. So I'm leading all these homeowners to use the equity position to take out the money as much as they can at this time. So this homeowner, first mortgage 500,000 at 3.25, and needs about $80,000 for the home remodel. Credit score is at 740. Seems like this person has plenty of equity. So the I guess objection came saying that I do not want to, and I'm not going to touch my refinance rate at 3% going into sevens. So this was related to one of Alex's client. So Alex, you had a situation like this, and you were able to navigate this client to some other loan product. Can you share with us how you overcame this situation?
Yes. Believe I saw the higher rate, correct? Was it that file?
Yes. So instead of offering 3% to 7% cash out refi, you offer something different. What did you do, and what was the homeowner's response?
Yeah, I mean, was this for Noelia or Marisol? I have so many files I can't remember.
Well,
like
you can
5.
generalize. You can generalize it. So he's working with you are working with a builder right now, right?
Yes, I work with a couple construction companies. Yeah.
So providing a GTL rebranded approval certificate is going to allow you to work many investors like Alex. But Alex, can you continue?
Yes. When had a situation, I believe the borrower didn't have enough for closing cost, right? And then we just sold a higher rate at that point. Is that the one?
Yes. And can you talk about the hybrid payment option where you sold the HELOC or HELOAN option?
I don't remember. I'm so sorry.
It's okay. It's okay.
I'm getting so many calls, and then I have like so many escrows. I can't remember. Like,
okay.
Yeah.
Well, this was one of my response to you, and I'm going to generalize again. I'm not going to say the borrower name. So instead of offering a 7% cash out, we offered 8.5% $80,000 HELOAN. The second lien, providing a payment option of blended rate of first and second versus the new 7%, we were still able to give something significantly better than any other companies. Because when you sell the higher loan amount at 7%, your commission can maximize. But by listening to what client wants to loan and wants to apply, we can extend our communication maybe 6 to 7 months down the road. Ask them how well they're doing with their new payment at 8.5%. And who knows when the market rate comes down, and be able to reposition as something better, something in 5s or 6s, or maybe extending the second trustee, the loan amount.
I always like telling my borrowers too, it's when I sell like a really high rate, right? I tell them just temporary, right? In 6 months, we do a rate and term for you, and I won't charge you origination, and I'll just make money on the rebate at that point.
Correct. Yes. That's the exact point that I want to make. So when the borrower is already giving you a hint that they don't want to touch the 3%, don't even mention about it. Leave that on and continue with second trustee options. And with MWest, CLTV goes to 80. With Vista, CLTV goes to 85. And Spring EQ, we're opening up non-del with them later next week. All the docs are in. CLTV goes up to 90%. Okay? So as a non-del representative selling multiple products, you don't have to tell the borrowers who the actual investors are. We, the lender, will provide XYZ, and the client will not see any of the details, fee worksheet, and the rebate amount. Let's move on. So this came along. Credit card payoff was one of the scenario. This homeowner is carrying about $45,000 of credit card. APR was at around 24%. So he was just making minimum payment of $1,350 a month and barely surviving. So I want to call this person a equity poor. He had so much on the paper, yet he doesn't know how to utilize his asset and equity. So he was anchored in at 3% rate. He doesn't want to do anything. His credit score is deteriorating from 800 to 650. It's going downhill. So what would you do? You quote a HE loan and say 9% rate, and as soon as the 9% was hit, they say that's too much, that's outrageous. So in this scenario, what I did is to reframe the comparison. So it's not a comparison in between 9% versus 3%. It's 9% versus 24% that they're currently paying. Okay? A 15-year HE loan at 9%, you can maximize at 6 points with Spring EQ. $45,000 at 9% is only $456. You reframe this comparing to the credit charges. So you are helping this person to save about $894 a month. So about $10,700 a year of breathing room that you are creating for this person. This is significantly higher than the closing cost. And second, loan amount under $250,000, you don't have to appraise and you can go to Plaza. Any loan amount to $400,000, you can go to Vista and do the refinance transactions. With Spring EQ, you don't even have to open escrow. You only need a title. So closing cost was under $1,000 with one of the Alex's HE loan deal, right? So one of these options, depending on whom the client is, you first identify the size of the borrower and then direct which direction to go. Is it A, B, or C? Yes and no can be determined by how you propose a debt consolidation options. A debt consolidation option close to a monthly payment, not on the rate, okay? Payment-driven options can be made on the writing format. And I want you to apply this on every single transaction. Don't compare the HE loan to the mortgage, HE loan to the credit debt. The 24% is where we are comparing. So you are, the person is paying. And next, the appraisal. So this client wants to tap into equity to pay the tuition. So unfortunately, she just passed the FAFSA deadline, so she has too much. So what does she do? Last year, a low appraisal value killed their cash out deal. So they were eating up the fees. They paid all the XYZ, but they couldn't complete the transaction. Now they're coming up and say, if the appraisal value comes in low again, then we're gonna waste money. But because of the previous failures, I don't want to continue the same failure with you. Last company took 3 weeks to give me a sorry, no thank you as an answer. You Giving Tree, Peter, how can you guarantee that you are different than the other mortgage company or banker? What would you do, right? So what I did is first identify and asked additional questions. The thing that burned last year's often isn't even part of the process, right? The way that we evaluate the subject property was an issue. So I don't know why the loan officer last year appraised the property. When I ran the DU, PIW came out with a higher appraisal value. With the refinance transactions, you always have an option, okay? So don't be hogged on by this full appraisal requirement product. There are so many offers and opportunities like CDAs, drive-by appraisals, BPOs that you can use on the second trust deed as well. We just need to check the physical portions of the subject property. So lower cost, faster closing, no appointment needed. It removes many different fears and exact, obstacles that the borrower had last year. So, and when you offer HE loan or HELOC with AVM or desk valuations, because the pressure is lesser, you can lead into the same 80% LTV, but you'll be able to have a higher opportunity, higher percentage to close the deal. And this continues with a previous topic that we covered. A borrower making too much money, my income limit passes, no waiver is given. Sales price at $600,000, and the listing was sitting there for 60-day plus. Loan amount at $570 at 7%, same set, right? Monthly payment at $37.92 a month. So borrower is saying, so at this payment, we'd rather keep waiting and pay the rent. So the catch here is the listing sitting on the market for 60 plus days. So what's your play as a loan officer? This is one of the plays that I did. Instead of waiting for the buyer agent to call the listing agent, I called the listing agent personally and then asked, hey, I have a buyer, XYZ is the situation. How much seller concession can you provide? And then I was driving the situation where a buyer agent is not needed. So you use the total amount of the buyer commission that was allocated to the buyer as a seller credit. And we were able to hash out. It's a little bit different approach, but as a loan officer, you can encourage the buyer to collect as much as possible and complete the transaction. A subject property giving away $3,000-$4,000 seller concession wouldn't make a deal. But when it's $13,000 to $15,000 seller concession, you can direct the conversation into something that can close. So you don't need to provide the lowest rate all the time. You just need a motivated seller and particular work pathway. Okay? You don't have to do it, but if you do it and step into that boundaries, understanding your do's and don'ts, then you can create another situational transaction. So this is the final one. Same couple with a new objection. So they say everyone who says rates are coming down are waiting at this time. Why buy now? Again, sales price at $600,000, 5% down, 7% rate, $37.92 a month. Nothing changed. So all we had at then was a Zillow trend market data showing the location of the subject property was appreciating about 3% a year. So this is information that anybody can just Google search and find out. What would you do? How do you answer rates are coming down? How can you say that? C, can you share in a situation like this, what would you say?
Absolutely. So we have data. This is exactly how I do it. Instead of being on a regular phone call, I'll actually request for them to be on a Google Meet call with me. And I'll tell them, look, whether you go through me or not, or whether you buy right now or not, I want to educate you so you know how to approach this, just in case if you miss on the opportunity right now. And I'll take them exactly to Zillow, show them where to go, how to get there, show them the trending data, okay? And basically say, look, if you want to wait, that's fine, but you're most likely going to pay anywhere between 3 to 5% more for the same property next year. Rates are temporary. It's something that we can always refinance you out of. And in fact, most of my customers, they go through me for their refinance 5 to 6 times during the life of the property that they're in. A lot of them, they come to me for upgrades or they're moving out of state, those type of things. But it's very normal. We have to show them that it's very normal. Refinancing a property multiple times is a very normal thing. Leveraging equity and being financially smart is a normal thing. And we use that through by using real estate strategically.
Perfect. It seems like you already saw my slides. Thank you for sharing. So this is how Giving Tree loan officers win. We price both futures, okay? Scenario math, don't apply any predictions on it. If the rate falls to 6.5 and the price rises to 3% to $618,000, that's $37.11 a month, saves about $81 a month, right? But the house costs $18,000 more. If the rate stays at 7%, $39.06, rating on the lost on both ends, right? Which option and future would you choose as a home buyer? Plus a year of amortization and appreciation. It's very easy transaction. So like C said, share screening options, visible content delivery is better than over the phone delivery. Our job is to create unseen to be seen within seconds and minutes using AI. I'm not going to say AI is eating up our industry. It is to the slow loan officers or stubborn loan officers who's not utilizing the AI correctly. If you know now what the new norms that we are going through, and as you hear from me what other opportunities are ahead of us and available for us, we have to build a habit of put things in writing and create Excel charts, not manually inputting one number at a time, using Gemini and calculate it and immediately plug it in. If you ask Gemini to create a Google Sheet using all the information that we have discussed on the chat, within a couple seconds, you're going to receive a Google Sheet link, which ties to Google Drive, and you can share that document to anyone who's involved in this transaction. Okay? So waiting is a bet where you pay the house $18,000 more just to sit at the table. Let's price both options, okay? And provide screenshot via text message, email with screenshots, a Loom recorded video talking about your projection. All can be viable option. Why are you trying to focus on only one option when we have all three options available, from visual to audio? So this is my proposal to all of you today. Before you run any of these play or scenarios, apply these 5 guardrails. So 1, never predict the rate or promise a future refi. So when you say you can just refi later, is UDAAP exposure. It's not a strategy, because what if the writing of yours is becoming an evidence that you have to provide a free refi? Or like Sarah said, how can you predict XYZ? What kind of a process, what kind of changes that we are going to go through and expect? You never know, right? So always create a conditional statement and find a way so that you're on the compliant. 2, waiting or refi talk is if-then scenario math in writing, like we have just mentioned, okay? So never, and 3rd, never coach income around the AMI limit. When you say how to navigate the AMI, we have to stop there. We cannot lead this person to create any document to show qualifying income. You'll be very surprised. At around this time of the year, people just update the pay stubs and year to date and submit it. Because we are only relying on the tax transcript from the previous year, we don't have any say on the year to date showing the pay stub. And surprisingly, Fannie Mae doesn't require a proof of deposit at this time. So please be careful whenever you approach any of these income-driven situations. Qualifying income follows documentation guidelines, okay? So be aware of what is expected. And 4th, verify the first-time homebuyer definition and AMI before you quote the waiver pricing. So we talked about the 3-year test rule, right? Promise, then retract kills the trust, files, and referrals. And lastly, 5, advertisement and social media postings must stay under Reg Z. So rate talk in the marketing or in the recording session like this follows the trigger terms rule. So we cannot say lowest rate possible. We have to prove why we are the lowest. Why we have the lowest rate amongst all the other options. If you cannot provide it, if you cannot show the proof of evidence, that's going against the compliance rules. So just having the loan sifter doesn't necessarily mean that we are the lowest rate, lowest fee lender possible. There are other people out there. You just can't bet on something that's uncertain at this time. These plays are powerful when you know the precise way. When you know everything line by line, then this precision is going to lead you to another victory very, very quickly. So this is what I want you to create on the weekly database so you can repeat it ongoing from today. For some of you, creating online postings, this AMI search tool and creating content out of it is an easy win. Let's say Fulton County, first-time home buyer with specific cities, with specific subject property. You can make multiple listings out of these. You can make multiple videos, collaborations with realtors. 2, AMI check on every conventional purchase pre-qualifications. And my recommendation is to just create an Excel and print it so you don't have to go back and forth. They are updated on the July 1st of every year. So we just had an update, 2 months ago? So that's a new standard that I'm going to encourage everyone. And third, rescreen your active pipeline at this time, any pre-qualification, pre-approvals that you have sent out. Any first-time home buyer that you priced out before June 30th, and then retouch them. You never know what kind of options we can provide. And four, call on the waiting for the rate client and send out an email blaster educating them what options, what possibilities that they can have, working with loan officers like us. Loan officer calling listing agent asking for concession is perfectly fine as long as we don't put our name on the purchase agreement. We can even drive a no realtor transaction, such as sell by owner, rent to own transactions. You never know. Find out what options you can have after the conversation. And the 5, save the 17 scenarios that we talked about. I'm going to share with you guys on the group chat and then go back and forth. You can just change the wordings and maybe use these opportunities to talk to real estate companies and do these seminars or presentations